Go.
Welcome back to Academic Market Insights. We have a treat for you today. We're going to be talking about the trading and the slowing down of private equity. Now, we've gotten this question from more than one of you. So this is, I know it's something on everybody's mind, but it's, I know, also on our community's mind of like, what do we do with this? We can see the writing on the wall. We can see that things are happening, but how does somebody trade it? What are people doing to trade it? And that's why it's such a special treat. It's a little bit different than our normal, hey, this is an educational thought process, but this is what's really going on. This is what people are really doing, and it's how people are responding. With that, Dr. Rowe, please take us down this path.
Here we go. So we talked a couple of months ago, we did a video on is private equity and there were some ETFs being offered that gave people exposure to private equity. And you know, is private equity appropriate for individuals? And basically the answer is no. And the reason that all of a sudden Wall Street is offering the ability to get exposure to private equity to Main Street usually means that a market has run its course. So we did talk about that. And in the area of big concern that's been in the headlines the past month or two is private lending. Or leveraged loans is another phrase for this. But there are entities that have been acting like banks and lending at maybe, you know, at substantial rates relative to market rates. But there's a reason that the folks they're lending to would pay 8 or 9% interest to borrow from them, and that's because they are a low quality borrower. So the private lending has been in a low interest rate environment, had been lending to a lot of private borrowers. We're now in an interest rate environment where things are creeping higher. Right now, as I sit here on March 27th, 2025, and that date's going to be important, or 28th, 2025, and that date's going to be important as we go forward. But we in the first quarter of 2026, we went from an environment where everybody felt we were going to get lower interest rates to where we're going to get higher interest rates. And private lending was already having trouble before that. Now they're really having some trouble. Yes, ma'am.
So you had spoken about higher interest rates for people with poor credit or
Mm-hmm.
people who can't get credit. Is this one of the reasons why interest rates are so high on credit cards?
Absolutely.
Okay.
Absolutely. It's an unsecured loan. And you know, if you're a bank and you're giving out a whole ton of unsecured loans, you want to charge a high interest rate to cover losses, and you're going to have some losses.
And
So
so for in private equity, the banks are anticipating some of this is not going to be repaid.
well, that's the thing with the private lending market is these are entities that aren't necessarily they're acting as a bank, but they are non-bank companies.
Mm.
So you've got to question the analysis that they are doing. And just about, and I don't think private lending is going to cause a crisis by itself, but I do think it's going to weigh on the markets over the next 6 months to a year or so. And that's because just about every financial firm has some sort of exposure to it. We started out hearing in the news firms like Blue Owl that really do focus in on private lending, and their stock has gotten decimated. There are a few others that are specifically focused on this. But as the story has started to develop, now you're hearing firms like JP Morgan talk about issues with private lending and how that's going to impact them. And this does remind me of the housing thing,
Hmm.
where you know we had Bear Stearns a year and a half before the housing crisis kicked in. They had a couple of hedge funds that were over leveraged with mortgage-backed securities. They went belly up. The firm got pulled into JP Morgan. So, you know, but it started out with very low quality lenders like Countrywide Credit. Those were the ones that were being pulled in front of Congress, but eventually it worked its way up the ladder to the big financial firms. I'm not sure if it's going to hit them like the 2008 crisis did, but firms that have a lot of exposure to private lending, they're going to have a tough go of it over the next, I would say, at least through the end of 2026. This slide comes from the last private lending, or where we did a presentation on private lending about a month or so ago, and I'll put the link below where I highlighted it. Previously, it said that the market was 2.5 to 3 trillion in early 2025. I've seen estimates as high as 3.5 trillion now. So it has been growing, and it's growing in a higher interest rate environment where it's more difficult to do business, which is a bit discouraging. And as I mentioned, it's one of those things that those of us in the financial industry have been aware of for a while and kind of discussing among ourselves. But now it's something that you see on CNBC almost every day, and you see in the headlines as well. And in fact, that's what kind of led me to talk about what we're going to talk about today. Yesterday, about an hour or so after the market opened, and yesterday, Friday, March 27th, about an hour after the market opened, this article hit thestreet.com, where Moody's just lost it. It says Moody's just lost its investment grade rating. It's not Moody's. It's FS KKR Capital Corp. That's who Moody's downgraded, and they actually downgraded them to junk, which is, yeah, that's somewhat discouraging. And they also mentioned Apollo and Blackstone, who have been facing elevated redemption caps. Right now, FS KKR, my understanding is 5.5% of their loans are non-performing. It's huge. And again, this is a lot of these numbers are before the Iran war started, and interest rate, and it looked like interest rates were going to be going down. Now with interest rates going up, and a lot of these private lenders, sometimes their source of funds or what they're making interest off of, that might start to become just an issue where their source of funds is costing them more than maybe the interest that they're charging people, if we do get a quick run up in interest, especially if they've got a duration disconnect like we saw with Silicon Valley Bank about 3 or 4 years ago. So, the private lending market is very tech focused. 20% of the loans out there are in the software technology space. There's been grand plans on a lot of spending in that area. It'll be interesting to see if that keeps up. It's no secret that I think that I think the spending on AI is not going to pay off. And in fact, one of the things that you always want to be skeptical of is when you hear one firm is merging with another, and they say, well, we're going to realize a lot of synergies, and we're going to see 30% cost savings. When I hear AI is going to make us more efficient and the money we spend on it is going to be recouped through cost savings, I think of the synergy argument that works maybe 1 out of 5 times with companies. That's just what pops in my mind. So Blackstone, I'm going to start with Blackstone here just because they're a big quality company. Mm-hmm. And I pulled up some price charts just to show that even though this is hitting the headlines now, if you back up, what's that, 5 or 6 months? You back up 6 months or so, these stocks have already come under a lot of pressure. So it is showing up in a drop of performance. And I know the banking sector has not done particularly well in 2026 as well. But Blackstone, which was mentioned as having a lot of exposure to private lending, their stock is already off over 42% off of that high that they realized. I think that was in September last year. So it's already off 42.7%. On Friday, after this article came out, I came across this option trade. And I don't want people to get all excited thinking I'm going to show some sort of exotic option trades here. All 3 of the trades are long-dated puts. And this first one was Friday afternoon. Blackstone was trading around 110.16. And keep in mind, again, that 110 level is over 40% down from its all-time high. Somebody came in and bought 400 of the January 2028. Wow. Oh my gosh. we'll be deep in the next presidential election at that point, since they kick off so early now. But January 2028, 95 strike puts for 1745. And the net result of that is a payoff that looks like this. There's where the stock was, just to break even at expiration. Now you can always sell these if the stock trades off to 75 or so, and there's a year or so left until maturity. You're going to be able to get out a little bit better than this. There will be some time value in there, but if you've got a 2-year outlook and you truly think that it's going to take that long for this to show up in the stock price, stock's got to go down 29.5% from where it was, not from the all-time high. And then if you sum up 42.7 and 29.5, that's over 70% off of its high.
Wow.
So that's now it might be somebody that owns shares that wants to hedge them, but in my mind, that's a pretty aggressive trade. And the daily option expirations that we even have in some stocks now, really, I think it has caused people to forget that you can put on a long-term trade using options or leaps, long-term equity appreciation securities, as opposed to just speculating on what stock's going to do over the next week or two. Yes, ma'am.
So for our number one fan, why would somebody get into a long dated put as opposed to simply selling the stock short?
Well, if we were to sell this stock short at 110.16 and everything, and this is the bottom, we're looking at 80 points of losses if all of a sudden it turns around and takes off back to the upside. So even though a lot has to happen for us to make money on this trade, a lot has to go right for us, if it doesn't work out, we know our maximum loss. And this is one of the things that does make puts attractive for individuals. Some of us can't, may have brokerage accounts where we're not allowed to sell short, but we might be able to buy options. And if you have been hearing about private lending issues and wondering, well, how do I go about playing the market on that? I think one of the better ways for individuals would be puts.
I do too.
Buying puts.
Yeah.
So the Apollo, Apollo, only 28% off of its high. They've got a bit more going on, and they're a bit more diversified than the last one we're going to talk about. But this one is 28% off of its high. Now, I didn't see any trades of note, long-dated put purchases of note on Friday, but I did see one a couple of days earlier in the week on Wednesday, March 25th, with the stock at 109.90. Somebody came in and bought 1,200 of the September 2026 100 strike puts. So they're looking at about 6 months. They think that the stock will sell off more over the next 6 months. This first one was 22 months, 2 months less than 2 years. This one is, again, only about 6 months. And you can see the break even is down a bit. It's down less than what we were looking for in that Blackstone trade, but it's still, you've got to drop 17.5% more just to hit that break even level. And this needs to happen in a much shorter time period. So, a trade like that first trade gives you a long time frame for things to work out. In fact, I did see a put purchase using leaps that expire next year that was done about 6 months ago. And you could see that you could just see that the time value of the options was holding up quite well. So they weren't, even though the stock hadn't started to drop as much as they were hoping, some of these put purchases have held up because there's a lot of fear around this sector. And again, you got to get a fairly big drop here just to break even on that trade. And then finally, the stock that we were just talking about, FS KKR Capital Corp. Yeah, I had to go back a bit because they achieved their high back in 2 years ago, or a year ago. Sorry, a year ago. But this is including all of 2025 and 2026. This guy is already 58.6% off of its high, and is the stock that a lot of people are focusing in on with respect to problems. And you can see they just got downgraded to junk status. Stock did come under a lot of pressure on Friday based on it coming under junk status. With the stock at 10.10 on Friday, again, after that article came out, somebody bought 600 of the FS KKR October of 26, 7 months to go, 10 strike puts for $1.65.
Wow.
That stock, I know, these are, I mean, out of the money put purchases with, a lot, again, having to go right for this trade to work out. And the break even is down about 14.4% from where the stock was trading when the trade went off. And if you sum that with the 58.6%, we're looking at well over a 70% drop for this trade to make money at expiration. Again, if you get a big Wall Street downgrade, you get a bad press release out of this company, it's very easy. You could see a 10 or 20% move to the downside in a single day. You'd see a pop in implied volatility. And if that happens to any of these three stocks, the first thing I'm going to do is go check in on these puts and see if people have monetized their trade yet or not. So I know not the most exciting option trade in the world. And one other thing with respect to buying puts, I did a study and I'm getting ready to update it. And one thing that has worked in the marketplace over the past few years is following institutional size put purchases. Mm. Partially because it's one of the places that things show up early. If you start to hear a rumor about a company, seeing if people are speculating on that rumor or not can give you an idea as to how much validity that rumor has. You can hear an awful lot of things, but you always want to see what the numbers are telling you as well. And the numbers are telling me that there are some concerns out there with respect to the private lending markets. And this is closer to the beginning of this problem than the end of this problem. Yeah. So there. So with that, you can take us home, Larissa.
Well, first, I want to say thank you so much for sharing this because this is just great insight. And again, I like that you're showing us puts as opposed to something that's, could be a little more convoluted. These are directional bets on these three different firms that institutions are taking. And again, when people are looking at downside, a firm falling apart, usually there's more research that goes into it. There's a lot more thought in putting something in that's almost going against the nature of the stock market, because we always assume that the stock market's going to go up. So this is great. So thank you so much for sharing that,
you betcha.
with us. And for all of you who've hung with us, we thank you so much for participating. We are open to other suggestions and questions that if you have, because, well, we enjoy doing it. So if you like this video, please hit like. And if you haven't, please subscribe. With that, we say thank you.